So let's get right into it. What is Forex? Number one, Forex is the largest and most liquid financial market in the world. Now, what that means is that because of its size, over $5 trillion a day being turned over, you're able to get in and out of your trades easier with no issues compared to any other market. You could add stocks, equities, options, and futures together, and it still wouldn't even be close to the amount of money that's turned over in the Forex market. So that size makes it very liquid, which makes it very easy to trade. Forex is freedom, and that's a big point for me because if you control how you make money, if you can take control of the skills that you do every single day and then use them to produce income, you can then control your time. And if you control your time, you have freedom. Where does that freedom then come from? The skill of trading Forex. So it's a big reason for me. It's the reason I got into trading. And on top of all of that, and this is something that a lot of people are not talking about, is that Forex is a new way to make money built for the 21st century. Day trading has been around for a fair amount of time. Stocks, options, and futures. Crypto's now a newer market too. But Forex is unique in itself because of its size and because of, again, how new it is. The retail broker space started in 1996. Not only that, modern internet didn't really kick in until 1999. So you're looking at a market that is less than 25 years old. In that situation, go back and look at any market, anything, any super successful business. Where was it 25 years into its, full potential? Nowhere near where it was going to be. So getting in now, getting in on the ground floor, getting in ahead of the curve is putting you in a position to not be replaced by a robot, not be outsourced to automation as we move forward in this digital technological age that we're about to live through, if not living through it already. But let's go back in time and talk about the history of the Forex market. So in 1819, England adopted the gold standard, and then in 1834, America followed them. In 1850, about 20 years later, Alexander Brown and Sons was the first bank in America to trade foreign currencies. A couple years after that, as more banks started getting involved doing this foreign currency trading, banks started to grow, more regulation was needed. The U.S. Federal Reserve was created in 1908. Now, between 1834 and 1940, we went from being on the gold standard with the price pegged at $20.67 to actually getting off the gold standard, having a rush on the banks, having to actually ask Americans to turn their gold over into dollars. Now, think about that. During the Depression, as you can see here on this timeline, in about 1929, people started to hoard gold. And what that forced the hand of the Federal Reserve to raise interest rates, which made the Great Depression actually worse. So it was like putting lighter fluid on top of the fire almost by hoarding the gold. So President Roosevelt had no other options other than to close the banks in 1933, reopen them, and relinquish all the gold to the Federal Reserve. It's an interesting concept, right? Roosevelt then asks Americans to come in and he says, hey, can you give us your gold so we can give it to the Fed and we'll give you dollars instead? He starts to introduce this very, very firm fiat money system. And then in 1934, the Gold Reserve Act prohibited the private ownership of gold, which is another interesting thing, right? To prohibit the ownership of gold, a limited resource, right? And then in 1939, it looks like everything worked. The Depression ended and we returned to a modified gold standard. But by the end of World War II, the gold standard was basically dead. World War I started to kill it in some of the European countries, and then World War II just completely demolished it. So in 1944, the Bretton Woods Agreement was signed, and that pegged the value of other nations' currencies to the dollar, the US dollar, which was pegged to the price of gold, now at $35 per ounce. So gold was raised to about $35 an ounce, and other nations' currencies were now directly tied to the value of the US dollar. This is when the US dollar started to become the world reserve currency. And that's a very pivotal moment in the history of our monetary system. Go about 30 years into the future, things weren't working out so well with the Bretton Woods Agreement. That forced Nixon to actually put the dollar into free float and cancel the Bretton Woods Agreement. The main reason for the failure was basically that there wasn't enough gold to back the US dollars that were in circulation. The Fed had worked and printed money to allow the government and private people to spend, lend, and what that caused is just too much money in circulation. There wasn't enough gold to actually equal the amount of money that was in circulation, the fiat money. So now we were going from a system that was completely on gold to kind of like a half gold, half fiat money because there was the floating money, but the gold was still on reserve. And now 1971, we say, screw it. The gold's just going to sit in the vault. We're not tying anything to gold anymore because there's just way too much money. This is out of hand almost. The money is floating everywhere. We just need to let that value float, let the global economy be what it's going to be. Not saying it's a good thing or a bad thing because I'm not an economist like that, but it's an interesting concept when you think about how quickly, within the span of 100 years, it went from being pegged to gold, which it had been for hundreds and hundreds of years before, to then being not at all, and now it's completely fiat based on these pieces of paper. Then, let's go a little bit forward now. We have the technological wave coming, the internet's starting to come out, and in 1996, the first online retail brokers are open. Throughout this entire process, throughout the Bretton Woods Agreement, throughout all of this, as these banks were formed, you didn't have Joe and Schmo from down the street going and trading Forex. It just wasn't happening. Banks were used to hold people's money, and that was it. They weren't placing these transactions. So the only people trading Forex at that time were big banks, big corporations, big institutions. But now, 1996, 97, internet starts getting a little popping. Retail brokers start popping up. You can actually get into Forex if you have access to the internet, and you still at that point needed a large amount of money. But as time went on, because we know how technology works, things evolve, things get cheaper, things get faster, and they get smaller. So what happened? More than 80% of Forex transactions now involve the dollar. Everything is around the dollar now. It's been that way since 1971. 60% of all the transactions that are done in the Forex market across all the brokers are done either in the UK or the United States. So two main powerhouses, and the rest of it's basically done in South Africa and Asia. So let's talk a little bit more about the participants of the Forex market. It starts at its core with the interbank market. The trades between the large banks form the core of the Forex market by volume. There's more to that though. The bank's continuous commitment to buy and sell currencies is a cornerstone of all pricing throughout the Forex market. Despite the huge volumes that go through the interbank market, we're talking over 50%, a large portion of Forex participants don't even have access. You and I can't trade within the interbank market. One of the foundations of this interbank market is the credit relationships that these large banks have between each other. The banks buy and sell currencies between themselves on a credit basis alone. Furthermore, the deals between this interbank market are typically very large with very, very small spreads, and like I said, are limited in terms of knowledge to the public. We don't know actually what they're doing. We don't know how much Citi is passing to JP Morgan, and that's part of what is the foundation of the Forex market, because these banks then price it out to the other market makers that we actually can interact with. So underneath the interbank market, it's the rest of us. We talk about the smaller banks, the large multinational institutions, pensions funds, hedge funds, insurance companies, and like I said, you and I, the individual traders. We are all underneath the interbank market. And the way that you can picture that is with this graphic here. You can see the central banks forming with large major banks that interbank market. Outside of them, we have, like I said, the investment funds, commercial insurance companies, big speculators, and then, of course, the ECN brokers, the market makers that get passed through to us. That's where we're taking our orders from. So when we talk about the two different types of Forex retail brokers for us, where that price is coming from, you either have a market maker or an ECN. The difference is pretty simple. Market makers create their own bid and ask spread, and they're very closely with the bank. And even market makers themselves have limited access to what they can do with that bank. So they're not part of the interbank market, but they're a little bit more tied to the bank than, for example, the Electronic Communications Network, the ECN. ECN is the most common form of retail broker that we will find, and in my opinion, they work really well for what we're trying to do. What you and I are trying to do is, either if you're a part-time guy, take yourself out of your 9 to 5 and start trading full-time, or if you're a full-time trader, like I said earlier, you're looking to level up, right? So if you're trying to do that, the ECNs are the best bet for us, I think, because they shop around for the best spread available from multiple market makers. You're not tied to one market maker. If you were tied to one market maker, you're probably getting good spreads and you're probably getting good deals because you're doing large size. But if you're not, like most of us, we need to use ECNs. ECNs are still going to provide a great tool, a great network to shop around that spread and get us the cheapest price possible. Those lower spreads, the reason we want to be shopped around to find the cheapest one is because that's going to keep our cost per trade very, very low. Okay? So when we talk about retail brokers, like I said, they're set up in partnership, cooperation, or as a subsidiary of a bank. And this is the broker that's going to hold your money. You could think of this as like your Wells Fargo bank account, your TD bank account, whatever bank you're using. This is your bank account, and you're going to deposit money here, and that's what you're going to use to trade with. That's the money you're going to use to trade with. Brokers have specific regulations, and I think it's important to discuss this before we even get into the charting. Some people will say, don't worry about brokers, just learn the charts. How could you do that if you need to hold money in a broker to actually trade and make money on the charts? So when we think about brokers, you want to make sure you're going with someone that's regulated, right? In the United States, that's either going to be the Commodities and Futures Trade Commission, the CFTC, or the National Futures Association, the NFA. If it's regulated by one or preferably both of those agencies, there's a couple of rules that they have to follow. For example, if there was a situation where there was a major flash crash, major market crash, these regulated brokers have to hold cash and pay out certain amounts to their clients, and that's part of being regulated. If you go with an unregulated broker that seems too good to be true, they might offer you higher leverage than that regulated broker, but your money is not protected like it is with the regulation. So you really want to do your research before you go jumping in, and I think that too many people get sucked into those unregulated brokers, and then a year later, after blowing 15 accounts, look back on it and say, damn, I should have just taken all that money that I funded those 15 accounts with and put it into the regulated broker. Even if it means trading smaller in the short term, you want to do that. And I'm going to explain all of this with the leverage and the margin in a little bit in chapter 2. But for now, just understand with the regulations, you more often than not, guys, you want to go with a regulated broker. It's just safer. If you're really in this for a business, if you're really here to do this in the long run, you really should be with a regulated broker. And honestly, if you're really trying to take it seriously, I would trade under an LLC so you can get the tax benefits of that as well. So what are we trading in Forex? Well, the short answer is nothing. The retail Forex market is purely speculative. There's no physical exchange of currencies that ever takes place. All trades exist simply as computer entries and are netted out depending on the market price. The primary reason that the Forex market exists is to facilitate the exchange of one currency into another for huge corporations that need to continually trade currencies for payroll, for payments of goods, for services to foreign vendors, for mergers and acquisitions and things like that. However, these day-to-day corporate needs compose only about 20% of the market volume. 80% of trades in the currency market are speculative in nature and conducted by large and small financial institutions, by multi-billion-dollar hedge funds, and by individuals like you and me who want to express their opinions on the economic and geopolitical events of the day. You can think of it as if Volkswagen wants to build a plant in Japan, they can't go and pay their Japanese workers with euros. They need to pay them with yen. So they would exchange euros for yen to then go pay their workers, to pay for their supplies, to do what they need to do in that foreign country. And those types of transactions happen all the time and are actually growing now more than ever because you have a shrinking world, basically, with technology. Technology is making it so much easier for me to partner with a guy in India now, or me to partner with a guy in Africa now. So with that shrinking world, more and more of these transactions are being done at different sizes, and that's only increasing the volume, which increases the opportunity for us. Now, currency exchange rates are quoted as you see here at the bottom. Two currencies, the euro to the dollar, then with two prices, the bid and the ask. And I'm going to break all that down for you as we go forward. Trading derivatives allows you to speculate on an asset's price movements without taking ownership of that asset. Most traders speculating on Forex prices will not plan to take delivery of the currency itself. Instead, they make exchange rate predictions to take advantage of price movements in the market. The most popular way of doing this is by trading in the spot Forex market. Now, like I said, trading on derivatives allows you to trade on an asset's price movements without actually owning it. So for instance, with the spot Forex trading, you can make a prediction on the direction in which you think a Forex currency pair's price will move. The extent to which your prediction is correct determines the profit or loss. Derivatives get their value from the underlying asset, which in this case is the currency pair. Now, currency pairs can be quoted in a couple different ways. We have major pairs. Major pairs include the US dollar, euro to the dollar, dollar to the yen, pound to the dollar, dollar to CAD, Canadian dollar, right? So you can see anything that includes the US dollar, either on the front end or the back end, will be a major currency pair. Compare that to a minor currency pair. These are pairs that have good volume, can be traded pretty easily, but don't include the US dollar. The major pairs are traded the most because they do include the dollar. The dollar is the world's reserve currency, and we know that over 60, 70, everybody says a different percentage, but let's just say over 50% of all transactions are including that US dollar. Now, there's also exotic currency pairs, as you can see, dollar TRY, which is the Turkish lira, the dollar peso, things like that with these emerging markets. So you might look at this and say, Austin, that's a base pair. The reason it's not is because the second pair that it's quoted to is a emerging market. The currencies in these countries are not as stable as the dollar, as the yen, as the pound, as the New Zealand dollar, right? So these exotic pairs are very volatile, much bigger spreads, much harder to predict their movement overall. So now that you understand that we trade currency pairs, not so much an asset or a piece of a company in the sense that you do in the stock market, I think it's important that we compare the two because a lot of people are very familiar, or think they are at least, with the stock market. But there are very clear, distinct differences between the Forex market and the stock market, and I think we should outline them. So the first one is you have to understand, and I said this before, is that the Forex market is much bigger. It exchanges over $5 trillion per day versus only $25 billion in the stock market. Now, $25 billion is still massive, of course, right? But $5 trillion compared to $25 billion is even more massive. So just on a sheer scale of size, you can see the difference there. We can also talk about the operating hours of the market. The stock market is limited to when the exchanges are opening. Now, of course, some people can trade pre-market and post-market overnight hours and things like that, but even that type of trading is limited when you're in the equity market. In the Forex market, it's open 5 days per week. It opens Sunday evening and closes Friday afternoon. So much more opportunity, much more just sheer time to trade, to be in the market, to be making money. So another, in my opinion, powerful characteristic of the Forex market. There's also greater volatility, where the stock market tends to have more stable prices that change over a long period of time, especially in the big blue chip and even mid-cap stocks. There are small caps that move a lot, but for the most part, the stock market has these stable prices that over the long term continuously basically go higher, right? So if you buy and hold, over the long run, people will say you'll make money. But that's not what we're here to do. Because although this is a great thing for, like I said, certain trading styles that buy and hold, the volatility of the Forex market actually can create an exciting range of opportunities for people like you and me that are shorter term traders, that are not so much the investor type of person. We're here to trade, we're here to make money today, and repeat that process over and over again, right? So again, that greater volatility is on your side in the Forex market. And lastly, there's no capital restrictions in the Forex market, whereas there's the pattern day trader rule, broker restrictions, and honestly, even taking that a little bit further, Forex pairs don't get halted, Forex pairs don't gap as much, and we're going to talk about that actually here. So even more powerful characteristics that will make the Forex market more attractive to you. If you were thinking about getting into the stock market, or if you're already in the stock market, you're not going to have to worry about a lot of the things that you do in the equity market when you start trading Forex. There's no manipulation to the same extent. Like I said before, you can't get in trouble for insider trading. There is no information that is privy because we're trading as soon as that information comes out, and that's moving the market itself. So it's all tied together in a much, I would say, it presents the chart cleaner, much more clean way compared to the stock market. So because there are no close end of each Forex day, right? There is a changeover of day, but there's no direct closes except, like I said, on Friday evening for the weekend. There aren't as many gaps, if any at all, in the Forex market. The most common time that you'll find gaps is over the weekend or during major economic releases. And the only reason that it happens during those news events, and we're going to dive into this in a later chapter, but the only reason that that happens is because your broker can't keep up with liquidity. For whatever reason, price moves too fast, the orders can't be filled, and price actually gaps. Now, that happens over the weekend if news breaks where Trump says something, tweets something, or whatever it is, this economic release comes out, or gold is on a short, whatever it is, that could get priced in come Sunday evening, but past that, you'll very, very rarely find gaps. And what this does is it makes it very easy for us to use technical indicators and use technical analysis to find very good, profitable trade setups. So it makes technical indicators work really well. So people ask me all the time, why Forex now? Why should I start trading now, Austin? Why should we shift into Forex now? You're here in the course because you understand that the global economic climate that we're living in right now is ripe. It's a good word, right? It's ripe with opportunities. It's with opportunities for us to take advantage of. Whether you want to talk about Trump and North Korea, Trump and China, Trump and Mexico, all of these trade deals just right there. Plus, how about the economic turmoil in Venezuela? All of these things are coming to play, and that creates opportunity in the Forex market. Can't forget Brexit. Can't forget the protests in Hong Kong. Can't forget the protests in France. I mean, all of these things create volatility, which actually scares a lot of investors away. But we are not investors. We're traders, and traders take advantage of opportunities as they present. So on top of that, you have access today to brokers more now than ever before. Like we talked about that entire timeline. How if you go back even 30 years ago, just 30 years, it was not even half as easy as it is to trade Forex today if you're an individual like you or I. So you got to take advantage of it today, right? Automation coming. We've talked about this a little bit. And if you are not aware of the fact that your job is potentially on the line to a program, to a robot, to some form of AI, then you are just being ignorant. But trading, this skill, this money-making skill, is AI proof. There's no way for you to lose your ability to trade just because robots enter the market. As long as you can adapt and learn, you're going to find new ways to make money trading Forex. Now, I said this before, how major news events create Forex setups, and I think that it's very important for you to understand. Brexit is one of the big headlines going on right now. Like I said, the China trade talks between the United States, the Mexico trade talks with the United States, Venezuela, Huawei ban, all of these things create opportunities in the market. They do not scare people like you and me away. Do you understand? You're here because you want that volatility. You want that excitement. That is where the good technical setups are going to present. If you can use these news events the right way in your trading, you're going to be able to find really, really solid technical setups. And if you're not updating the way that you earn an income, like I said this, I think 3 or 4 times already, you're going to get left behind. This is a study from McKinsey & Company. It's a consulting firm. They're saying 6 out of 10 current occupations have more than 30% of their activities that are technically automatable, which means they can be taken out. 6 out of 10 occupations are already 30% automatable. Now, on top of that, and I've said this all over social media before, by 2030, these guys are predicting that between 400 million and 800 million people will be displaced by automation, either needing a new job or needing a new job within their current occupation. So with that coming, with that 400 to 800 million people that could be impacted, I think more and more you're going to see people turn to Forex trading as a way to make an income, as a way to prevent them from losing income when this automation comes, because it's inevitable, it's coming. But if you can take a step to the left instead of trying to fight it head on, you can learn this new skill and then actually move forward faster and be safer for the long run. And that's, again, why I'm such a big proponent of teaching how to trade. So what did we learn in this first chapter? Well, number one, remember that Forex is the most liquid, most accessible, and has the most money-making potential over any other market, including the stock market. So you are in the right market. We are trading currency pairs, but we never own any currency outright. It's a derivative market, which means we trade the value of that asset without actually owning that asset. Forex is a way to make money built for the technological takeover that we are living through. I think you understand at this point, AI is coming, and we are now going to be prepared because of what we're going to learn in this course. And like I said, if you ignore it, you're going to be ignorant, and by the time you realize it, it's going to only be too late. So now that we understand what Forex is, let's move into some of the terminology that you need to understand before we start looking at some charts.